Most investors believe the secret to success is finding the next big thing, the next stock, the next crypto, the next boom. But the truth? Most of them are already losing. Not because the market hates them, but because they never learned the rule that protects their money from disappearing. Benjamin Graham, the man who taught Warren Buffett, the father of value investing, had a single law that separated the intelligent investor from the reckless gambler. He called it the rule. Simple, unbreakable. And it is not about how much money you make. It is about how much you never lose. You see, Graham didn't chase excitement. He studied human nature. He saw that in every market crash, in every panic, the people who survived weren't the smartest. They were the most disciplined. They followed a principle so powerful that it turned volatility into opportunity and fear into profit. But here's the strange thing. Even though this idea built the foundation of modern investing, most people today completely ignore it. They scroll through headlines, follow trends, and gamble with their futures, all while calling it investing. And the irony? The greatest protection ever discovered in finance isn't hidden in algorithms or AI. It was written nearly a century ago by a quiet man who believed in logic over luck. Benjamin Graham once said, "The essence of investment management is the management of risks, not the management of returns." That's the key. The wealthy don't win by taking more chances. They win by protecting themselves from loss, by building a margin between risk and ruin. So before you invest another dollar, before you trust another headline, ask yourself one question. Do I have the margin of safety Benjamin Graham demanded? Because when markets fall, when panic takes over, when everyone else is losing, that rule is the only thing standing between your wealth and your downfall. Today, we uncover the philosophy behind it. Not a trick, not a system, but a timeless rule. The one that made Warren Buffett say, "Ben Graham was the greatest teacher any investor could ever have." And by the end of this video, you'll understand why he taught. Never invest without this rule. Benjamin Graham didn't see investing as a game. He saw it as a discipline of protection. While others were guessing what would go up, he was asking a far deeper question. How do I make sure I never lose? His philosophy wasn't built on predictions, but on preparation. In his most famous words, Graham wrote, "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return." Notice, he didn't say maximum return. He said adequate. That one word separated him from everyone else. Because in Graham's mind, intelligence wasn't about making money fast. It was about keeping money safe and letting time do the rest. To him, defense was the foundation of every great fortune. He believed the investor's first job was not to find opportunity, it was to build protection. And protection came from three things: analysis, patience, and margin of safety. Most people enter the market with emotion, excitement, greed, fear, the very enemies Graham warned against. He said markets are there to serve you, not instruct you. When prices fall, you buy opportunity. When prices rise beyond reason, you walk away. And when you can't decide, you wait. Graham's approach was rooted in logic, not luck. He didn't believe in timing markets or chasing trends. He believed in understanding value, the true worth of a business compared to the price you pay. He taught that price is what you pay, but value is what you get. That small difference is where wealth is born. In his classroom at Columbia University, he trained generations of investors, people who would go on to manage billions. But his real lesson was never about money. It was about temperament. He used to say, the investor's chief problem, and even his worst enemy, is likely to be himself. And he was right. Because what ruins most investors isn't bad advice, it's bad emotion. The moment you panic, you sell low. The moment you get greedy, you buy high. And every cycle repeats. Graham's students learned that the market rewards the disciplined few who can think clearly when everyone else is losing their minds. That's why Warren Buffett called Graham's teachings the bedrock of everything I know about investing. Benjamin Graham's philosophy can be summed up in one sentence. If you want to build wealth that lasts, Build it on safety first. That's where the next rule begins, his hidden rule, the one that separates investors who survive from those who disappear. And it's not about avoiding risk, it's about understanding it. Most investors think risk means watching prices fall. But Benjamin Graham saw it differently. He said, the true measure of risk isn't the ups and downs of the market. It is the chance that you will lose money and never recover. That's the hidden rule, the one few ever grasp. To Graham, volatility wasn't danger, it was noise. Because prices swing every day, but value, true worth, moves slowly, like the tide. He taught that a smart investor ignores the waves and studies the ocean. Imagine this. You invest $100,000 and it falls by half. You now have $50,000. To get back, you don't need 50%. You need 100%. That is the brutal math of loss. The reason Graham built his entire strategy around not losing first. He knew every dollar lost steals time, the one resource you can't compound. That's why he created the concept of margin of safety. It's the space between what something is worth and what you pay for it. It's a cushion for error, uncertainty, and human emotion. Because no matter how brilliant your analysis is, you can still be wrong. And the margin of safety is what keeps you alive when you are. He compared it to building a bridge. If a bridge must hold 10 tons, an engineer designs it to hold 30. Why? Because life is unpredictable. Markets are unpredictable. And the investor who ignores that truth eventually collapses under the unexpected weight. Graham warned, the essence of investment management is the management of risks, not the management of returns. He believed that controlling risk was an act of humility. You don't try to be smarter than the market, you try to survive it. And survival is underrated. In today's world, investors confuse movement with progress. They see someone making fast gains and assume that's success. But in Graham's eyes, true success is still standing after everyone else has fallen. His students learned that protecting your capital is the real secret to compounding wealth. Because when your foundation never cracks, time becomes your greatest ally. And over decades, protection outperforms prediction. The hidden rule is simple, yet almost no one follows it. Don't measure your success by how much you gain in a bull market. Measure it by how little you lose in a bear market. That's how you win quietly and last forever. And this is why Graham's ideas still dominate nearly a century later, because he wasn't teaching a method, he was teaching a mindset we'll now see in action. Benjamin Graham didn't just preach theory, he engineered a framework, one so powerful that it still shapes every intelligent investor today. He called it the margin of safety. It sounds complex, but it is simple enough for a child to understand, and profound enough for Warren Buffett to build his empire upon. The margin of safety means this. You buy an asset for less than it's worth. You give yourself room to be wrong, because in the markets, everyone is wrong. Eventually. Imagine a bridge built to hold 10 tons. A careless builder designs it for exactly 10. Graham's engineer, he designs it for 30. Why? Because reality doesn't read your blueprint. It surprises you. It rains harder. The wind blows stronger. And in the world of investing, that unexpected weight, that sudden crash, crisis, or panic, is what destroys those who built too close to the limit. So Graham built differently. He didn't chase excitement. He built resilience. He sought companies selling for less than their real value. He demanded financial strength, low debt, steady earnings, honest management. He wanted investors to buy businesses, not tickers, to think like owners, not speculators. Because if a company is worth $100 and you pay $60, even if your estimate is slightly off, you still survive. But if you pay $110 for a dream, you've already lost before the market proves you wrong. That difference, that space for error, is where true wealth grows quietly. And Graham's students carried this idea everywhere. Buffett used it to build Berkshire Hathaway. Seth Klarman wrote Margin of Safety as his investing gospel. Even modern risk managers quote Graham's words without realizing it. The purpose of investing is not to make money fast, but to avoid losing it permanently. But here is what makes Graham's idea timeless. It wasn't just about money. He believed the margin of safety applies to life itself. You don't book every hour of your day. You leave time to think. You don't spend every dollar you earn. You leave room for the unexpected. Because whether in investing or in living, those who leave no margin are always one shock away from collapse. Graham's wisdom was less about beating others and more about protecting yourself from yourself. Because the most dangerous market isn't outside. It's in your own emotions. He once wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." So he built his philosophy around calmness. He treated patience as profit. And he designed a system that rewarded the disciplined, not the daring. The margin of safety wasn't just his tool, it was his shield, a way to endure storms and still sleep peacefully at night. Because in the end, the investors who survive longest aren't the ones who predict the next boom. They're the ones who design for the next crash. In today's world, everyone wants to be an investor, but few understand what that word even means. Benjamin Graham saw this confusion coming almost a century ago. He warned that most people don't invest. They speculate. They don't analyze. They predict. They don't study. They gamble. And that single misunderstanding is what destroys wealth faster than any market crash ever could. Graham used to say, "The distinction between investment and speculation in common stocks has always been a useful one, and its disappearance is a cause for concern." He believed speculation wasn't evil. It was just dangerous when you didn't know you were doing it. Today, millions open an app and call themselves investors. They buy because a friend tweeted or a video went viral. They measure success in weeks instead of decades. They believe intelligence will save them. That if they just find the next Apple or Tesla early enough, they'll win. But Graham knew the truth. Intelligence without discipline is just another form of arrogance. He saw it again and again. The smart ones who couldn't sit still, who couldn't resist the noise, who thought volatility was risk when the real risk was losing themselves in the chase. Because markets don't punish ignorance, they punish ego. And Graham's greatest lesson wasn't about money at all. It was about temperament. He said the intelligent investor is not the one with the best IQ, but the one with the right character. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. So, what do people get wrong? They think wealth is built through prediction, but Graham built his through protection. They think success comes from brilliance, but Graham taught it comes from behavior. They think the market is a game to beat, but Graham knew it's a mirror that reflects your patience, your fear, and your greed. He called the market Mr. Market, a manic partner who shows up every day offering to buy or sell your shares at absurd prices. Most people dance with him. Graham just watched him, calmly, patiently. He bought only when value appeared and ignored him the rest of the time. That simple act of not reacting is what separates the wise from the broke. And that's what people still get wrong today. They think the secret is hidden in formulas, charts, or insider tips. But Graham's secret was self-control. Because investing isn't about finding the next big thing. It's about avoiding the next big mistake. That's why Warren Buffett said, "I'm 15% Fisher and 85% Benjamin Graham." Because even decades later, Buffett built his empire not on speed or speculation, but on discipline and defense. And that's the irony. Everyone wants to make more money. But Graham taught the first step to making more is learning to lose less. He proved that wealth isn't created in the excitement of the trade, but in the silence of patience. And those who can't bear that silence never hear compounding's whisper. Benjamin Graham didn't just teach how to invest money. He taught how to invest yourself. His ideas were never meant only for Wall Street. They were meant for anyone trying to survive the noise of the world. He believed that wealth, like wisdom, comes to those who build habits, not those who chase excitement. Because every investor's greatest battle isn't with the market, it's with their own mind. Graham once said, "The investor's chief problem, and even his worst enemy, is likely to be himself." He knew the real secret to compounding wasn't math, it was temperament. Anyone can calculate. Few can control themselves when everyone else is losing their heads. The Graham mindset is built on 3 pillars: Patience, protection, and principle. Patience. Graham believed time was your greatest ally. He knew that value doesn't reveal itself overnight. It unfolds. Like a seed under the soil, it takes faith to wait when nothing seems to grow. The impatient dig it up, the wise water it. Protection. While others rushed toward opportunity, Graham built defenses. He kept cash when others mocked him for being cautious. He said, "Be prepared for the unexpected, because the unexpected always comes." He invested like a soldier, not a gambler, always ready for the storms. Principle, perhaps his most underrated virtue. Graham never confused price with value or wealth with worth. He believed integrity was an investor's truest margin of safety, because a person who betrays their principles for profit has already lost. The Graham mindset is not about fear. It is about freedom. The kind that comes from knowing you can be shaken by every headline, every market drop, every whisper of panic. It's about finding peace in preparation. Visual. Show young investor closing laptop, going for a walk, voice softens. When you invest like Graham, you stop chasing the market and start mastering yourself. You stop asking, "What's next to buy?" and start asking, "What's worth holding for a lifetime?" Because Graham wasn't teaching finance. He was teaching philosophy disguised as numbers, a code for living in a world addicted to noise. He taught that every good investment begins with one simple question: will I be okay if I'm wrong? That's humility. That's foresight. That's wisdom. And when you build your life, your wealth, and your mindset on that foundation, you stop playing the short game. You stop gambling with your future. You begin, slowly and quietly, to own it. So build your wealth the Graham way, slowly, thoughtfully, and with purpose. Because, as he proved, fortune favors not the fearless, but the patient. And the greatest investment you'll ever make is in your ability to think independently, while everyone else is reacting emotionally. Benjamin Graham didn't build an empire. He built a blueprint, one that outlived him, a guide not for chasing money, but for mastering yourself. In a world that worships speed, Graham taught slowness. In a culture addicted to risk, he preached restraint. And in an era obsessed with being right, he reminded us, the first rule of investing is simply not to be stupid. That's the paradox of wisdom. It doesn't shout. It whispers. It hides inside the quiet moments when you decide not to follow the crowd. You see, never lose money wasn't about fear. It was about freedom. Because when you learn to protect your capital, your time, and your peace of mind, you stop being controlled by the chaos around you. Graham's real lesson wasn't how to get rich. It was how to stay calm while you do. Because wealth without wisdom eventually destroys itself. Warren Buffett called Benjamin Graham his greatest teacher, not because he taught him how to pick stocks, but because he taught him how to think. That's the real inheritance of Graham's philosophy. Thinking independently when others panic, acting rationally when others react emotionally, and understanding that sometimes doing nothing is the most profitable move you can make. So tonight, wherever you are, remember this. You don't need to predict the next big stock. You don't need to outsmart the market. You just need to protect yourself from the one person most likely to sabotage your success. You. That's the quiet mastery Graham left us. The art of staying rich in wisdom, not just in wealth. And if this message resonated with you, if you believe wealth built on patience is stronger than wealth built on hype, then subscribe to Depth Invest. Because here, we don't chase the noise. We listen to the wisdom that time refuses to erase.